Hey everyone, in this episode I'll be talking about why negative gearing is actually not a great idea. Okay, so if you're thinking about buying an investment property that's going to cost you some money to hold every year, then this episode will completely shift the way you think about property investing. At the end, I'll actually give you a reason why it makes sense to negatively gear, but it may not be best for everyone. So my name's PK, and I've helped hundreds of people build passive income through property investing using data without gambling on a $15,000 buyer's agent. And this channel exists to help property investors and home buyers really get ahead through Australian real estate. So I'm grateful for each and every one of you that are part of this community. If you like what you see, subscribe, turn the notification bell on, and tell me if you get value by giving it a thumbs up. So we'll be talking about 6 negatives of negative gearing. Okay, 6 negatives of negative gearing, and at the end, 1 positive. Okay, so number 1, what negative gearing is not is a strategy. It is a tax outcome. So negative gearing, for those of you who don't know, simply means that if I'm getting, let's say, $20,000 of a rental income, gross rental income per year in my investment property, all of the outgoings or all the costs, including mortgage, council rates, property management fees, insurance, all that kind of thing, adds up to more than 20K. Okay, let's say all the costs add up to 25,000. So you've made 20,000, you've needed to spend 25,000. Negative gearing simply means that $5,000 loss, okay, you can offset against your income from your job or your business. So let's say you made $100,000 per annum working as an accountant. In your property investing, you've lost in that year $5,000. So instead of being taxed on $100,000 by the ATO on your accounting job, you're taxed on $95,000. So think about it. Yes, you do save tax, but you've lost a whole bunch of money to save a little bit of tax. You've lost $5,000 to save, depending on your tax bracket, either 33% of 5,000 to save either 37% of 5,000 or perhaps 45% of 5,000. Nonetheless, you've still lost money. Okay, so you've lost a lot to just get a little bit back of that loss after tax. So negative gearing is not a strategy, it's simply a tax outcome. And when you think about it like that, you start to realize that all of these property investment firms and companies talking about how, you've seen their ads. I'm not going to mention their names. You've seen their ads here on YouTube probably before this episode started. You probably saw one of their ads on Facebook. You see those ads, claim back tax, how Australians, tap into the secret hack of how to save tax. This is it, right? It's not a strategy, it's a tax outcome and a suboptimal one. You're losing a whole bunch of money to just get a little bit back after tax. Even if you're on a high income, you're still losing more than what you are getting back in tax. Connect with that point. Number 2, a reason why negative gearing really does suck. I just want to re-emphasize, number 2, you lose money. Okay, so you're buying an asset, a $300,000, $400,000, $500,000, $600,000, $700,000 property that is costing you money every single year, even after tax. It's costing you money to hold. So you've invested your hard-earned money into an asset that's really just a liability because it's costing you to hold it. Okay, like it doesn't, it's sort of like you have to rewire your brain to see things clearly. You've just invested, done all this work only to intentionally lose money. That's the second reason negative gearing sucks. The third reason for negative gearing being suckful or why it sucks is that it affects your borrowing capacity. So if you want to build a large property portfolio, whether that's 2 properties, 5 properties, 10 properties, everyone's different. If you buy negatively geared property, then even if you're on $150,000, $200,000, $300,000 income per year in your household, you're still telling the banks that I'm buying more and more losing assets. I'm buying more and more assets that are costing money. The banks are not going to allow you to get that second property, that third property, that fourth property, maybe that fifth property. Every negatively geared property you buy is preventing you, in the bank's eyes, in terms of their serviceability calculators, in terms of their appetite to lend you money. You're telling them that I have less of a ability to buy another property. They will give you less of a loan if you buy negatively geared properties. So if you genuinely want to build a portfolio, you would never ever buy a negatively geared property, because you'll inhibit every property that's negatively geared. You're inhibiting your ability to get to the next one. Okay, that's the third reason. The fourth reason you really don't want to buy negatively geared properties is that because they lose money, they affect your lifestyle. All right, so just think about it. Every property that you buy, it's like a vanity metric. Oh, I've got 5 properties, I've got 3 properties, I've got 7 properties. But actually, you've just affected your lifestyle. You can't go on those holidays. You can't, get those additional, eating out every week, or, those presents, just all those nice to haves, those luxuries that we all like to have, right? You can't get them. You have the bragging rights of being able to say, yeah, I have 3 properties or 5 properties or whatever. But actually, the person that has no properties is making more money than you. The person that has no properties, from a cash flow perspective, is living a better lifestyle than you, because you have this debt, not only debt, but you have this negative cash flow because of negatively geared properties. Okay, that's the fourth reason. The fifth reason why you don't want to buy negatively geared properties is that the more you buy, counterintuitively, the more you're reliant on your job. So let's say you have 4 or 5, or let's just be modest and say you have 2 negatively geared properties. They're costing you let's say you're in Sydney, like $5, $10, $15, $20,000 per annum, which is very normal in Sydney, Melbourne, even inner city Brisbane these days. All these properties are, going to cost you around $10,000, $15,000 per year to hold. What that actually means is that, presumably you're investing in property because you want to exit the rat race, but by buying all these negatively geared properties, you're just implicating yourself more. You're more reliant on your job than ever before, right? If you lose your job or you want to leave your job, you can't afford to service that debt. You can't afford to actually make those interest repayments. You can't afford to hold those properties, in which case you have this pressure, this headache, this anxiety. It's like a caterpillar. I think a caterpillar, what they do is that they build themselves in a cocoon, right? They kind of weave themselves in a cocoon. I think it's a caterpillar, it might be something else. And they build their own jail, right? That's what they do. And so it's like they're protecting themselves, but actually they can't leave. It's like they've all that silkworm. It's a silkworm, not a caterpillar. A silkworm protects itself by building, all these silk threads all around it, but then it can't escape, right? So you're like a silkworm. You're thinking in vanity that you're building wealth, but actually you're trapping yourself in your 9-to-5 job. Okay, I think that we're up to 5. And then the sixth reason why a negatively geared property just doesn't make sense in this day and age is that you don't need to negatively gear. The way that interest rates are, even if they go up by 2%, they go up to 4% or something like that, you can still buy positively geared property. And anyone who says that you can't get both positive cash flow properties and growth, because that's what you're probably thinking, PK's ranting, he doesn't realize that actually I want growth as well. You can get both, right? Anyone who says, any advisor or expert or guru that says you need to buy within 10Ks, within 20Ks of Sydney, Melbourne, Brisbane, negatively geared investment grade properties to get growth, doesn't know what they're talking about. I know there's tons of people with books and huge podcasts and huge followings that say this, but you actually don't need to. Let me just tell you, if you bought 5 years ago in Geelong, positively geared territory, you would have almost doubled your money. You bought 3 years, 4 years ago in Ballarat or Bendigo, you got more growth than what you would have got in Melbourne, Sydney, Brisbane, and it was positive cash flow. If you bought places like Gold Coast, you bought in places, even like Toowoomba as more recently, bought in places like Orange, you doubled your money and had positive cash flow, like $5,000-$10,000 of positive cash flow per property. So this isn't like I'm not going into a regional versus capital city debate. The debate that I'm going into is to say you don't need to make trade-offs between growth, short and sustainable long-term growth, and positive cash flow. So buying negatively geared property is like saying, I'm going to leave money on the table purposely because I choose to believe myths that aren't correct. I choose to believe that you need to buy as close to the CBD in a capital city to be a successful property investor. Now, thank you for watching all the way to the end, because here I'm going to tell you one reason why actually negative gearing can be okay. And the reason is that, back to that example, if you got $20,000 of rental income in a year, but made a $5,000 loss because your expenses were $25,000, if you had great depreciation on that property, let's say the depreciation was $10,000 per year. Now, depreciation is an accounting treatment. It's not something you actually have to pay. It's not like a cash expense. But in the ATO's mindset, in the tax office's purview, they still see it as an expense, right? So if you've made a income of $20,000, your cash expenses, same example, at $25,000, you've made a loss, right, of $5,000. But if your depreciation expense was, let's say, $10,000, a non-cash, simply accounting expense, and if you're on the highest tax bracket, like 45%, then the ATO is going to give you half of that, or 45% of that depreciation expense back after tax. And so that's, call it $5,000, round numbers. So that $5,000 loss that you made is offset by that depreciation benefit. So actually that negatively geared property becomes neutrally geared. Now that's not a common scenario. And also remember, all of this depreciation benefit that you receive from the ATO, if and when you sell, you need to pay about half of that back to the ATO. So it's not like free money, but that's just one slight nuance that I want you to understand. It's something that you need to consider if you are going to buy negatively geared properties. If you're ignoring this episode and saying, look, I just want to be investing like this, stick to a $1 million, $600, $700, $800, $900 million property in a capital city, then at least make the most of this benefit. Okay, guys, so hopefully that this episode brought you a ton of value. I want to ask you, tell me below, give me a yes if you own a negatively geared property, and give me a no if you own positively geared property. I just want to see what kind of portfolios this community has. So if you have a negatively geared property or a positive cash flow property, leave it in the comments below, and we can see what kind of disparate community we have. Okay, guys, so if you want to step up your learning, feel free to join my free Facebook group and check out my website. Links are below. And don't forget to answer that question. Do you have a negatively geared property? Leave it in the comments below. Do you have a positive cash flow property? Tell me in the comments below. My name's PK, and thank you for listening, watching, or wherever you consume this. Catch you later.